Craig, did you have a good rest of your day, sir?
I haven't left this desk since you left my office.
Yeah.
Actually been busy. I'll be right back.
Tanner, how's the weather down there in lovely St. Pete, Tampa area?
It's nice, man. It's high of 73, low of 67. It's the best time of year down here. Thank
Yeah.
goodness if it gets below 55, I think the city shuts down.
It's like it's snowing in Charlotte, right?
Yeah, exactly.
That's good stuff. Yeah. Sherry's mom's actually down in Land Lakes, as I mentioned to you, and she's coming up here on Friday and staying through Wednesday. So excited to see her. And I love going down there because I just give them QT time and I just go fishing.
There you go.
Yeah.
There's good fishing down here.
You got that right. And you don't have to go far.
Exactly.
I fish under the causeway right there over to St. Pete, and I think I caught 4 different species last time I was there, just right there, and then got a guide and he took me out, and I think we caught like 3 more. So it was fun. We had a good time.
I believe it. The I'd probably say about half the time we go fishing out by the causeway, I'll catch a tarpon. Sometimes they're bigger, sometimes they're smaller, but always a good fight.
Oh man, tarpon, that's the apogee. Just about there, Craig.
Yeah, just everybody that's coming in right now, we're going to start right on time. And Judd's going to be doing most of the talking as I'm losing it.
Poor Craig.
Judd, you can start whenever you need to.
Okay, we'll let my iPhone tick to 6:30 and let everybody get in here. We still got a couple people flowing in, which is great news. I think we're going to have really fantastic participation again tonight, and got some great speakers lined up for us. I'm excited to have Amy on. All right, well, here we are, 6:30. We're going to start right on time and be conscious of everybody's holiday season here. I am Judson G, certified estate planner and managing partner for JHG Financial. We have been in business for, 20 some years now, and I have been a federally licensed securities representative for coming up on 30. My firm is JHG Financial, and our moniker is we help protect your financial blind sides. We have got Craig Lancaster, my personal CPA, tax guru. Just met with some new clients. I forced him to take on some new clients today. Thank you, Craig. And he is with, of course, Mooresville Tax Service. We partner up informally to help our clients with tax strategies, etc. I, of course, being federally licensed, need to put some disclosures up here from my broker dealer, and this presentation is for educational purposes only, and is not a recommendation to buy or sell. Also, this material has been prepared for informational purposes and is not intended to provide and should not be relied on for tax, legal, or accounting advice. That is for Craig and or your tax attorney. I always like to start off our webinars with a great quote from the amazing Warren Buffett. And I like this one a lot. It says, I will tell you how to become rich. Close the doors, be fearful when others are greedy, and greedy when others are fearful. Again, we are blessed to have Amy on. I met Amy at the Tax Preparers National Association meeting back in August, I think, Craig. And she was amazing to talk with. And so Amy Wall, she teaches and has written books. And so, Amy, I'm going to go ahead and turn it on over to you and stop sharing my screen, and I will shut up and let the experts talk.
Okay, I'm on it. Thank you for that introduction. Can you see my screen okay?
Yes.
Yes.
Okay. All right. So my part of this thing here tonight is to talk about taxes, which is just full disclosure, not everybody's favorite topic. So you already heard about me. So here's what I'm going to talk about today. I'm just going to give you a really brief overview of how the tax system works. And I'm doing that because a lot of very smart people really don't understand tax brackets. So I'm just going to give you a couple of minutes on tax brackets, just so we're all on the same page moving forward. I'm going to talk about taxes on investment income. Going to give you some ideas for how to save money on taxes. I'm going to talk about charitable gifting, which becomes a big deal in the higher socioeconomic brackets. And finally, I'm going to talk about retirement strategies. So first, how the tax system works. Different types of income are taxed differently. There's ordinary income, there's earned income, capital gains, and then there are special types of taxes. Not all income is taxed the same way. That's very important to understand when we start talking about investments. Taxes are typically set up in brackets, tax brackets. And people very often, like I say, some very smart people don't really understand how tax brackets work. I hear people say, if I had understand that raise was going to put me in a different tax bracket, I would have turned it down. And I think, oh my God, you really don't understand this, do you? So I'm going to just give you a quick overview on how tax brackets work. We start with gross income, which is all taxable income, all the income that you get. Then we subtract deductions and adjustments to get to the taxable income. And then that taxable income is sorted into various tax brackets. You are never taxed at the top rate on all your income. So here's how the 2023 brackets line up. So you can see there's a 10% bracket, a 12% bracket, then it jumps to 22%, 24%, 32%, 35%, and the top bracket is 37%. So as you can see from the different columns, how this income gets sorted depends on what we call your filing status. So there's a single filing status, people who are just filing by themselves. Married filing joint, you can see that it's basically twice as much money per bracket. And then there's this kind of in-between thing called head of household, which I'm not going to get into details on what head of household means. That's kind of outside the scope of this discussion. So how it actually works is we have a standard deduction for married filing joint of $27,700. So that gets subtracted from your gross income. Then of the remaining amount, again, this is for married filing joint example, 22,000 is allocated to that 10% bracket. Then the next $69,000, $67,000 is allocated to the 12% bracket. So it never all goes into that top bracket. Those lower amounts remain in those brackets. So there's a 35% and then there's a 37% for the top earners. So for example, let's say Harry and Sally are married, their 2023 gross income is $150,000. We subtract out their standard deductions. There's a couple other adjustments. Now their taxable income is down to $120,800. The first $22,000 is taxed at 10%. No matter how high up they go, that first $22,000 is taxed at 10%. Then the 12% bracket gets applied to the taxable income between $22,000 and $89,450. So now we've got a chunk of tax of $8,094. And then finally, the remaining income is taxed at the 22% bracket. So what we say is, although their marginal tax rate, that's the technical terminology, is 22%, their overall tax rate is actually only 11.34%. So no matter how high up it goes, there's no tax on deductions and adjustments. And that first chunk is taxed at 10%. The next chunk is 12%. So it's not like your whole income goes into that top tax bracket. And that's one of the things folks don't understand. So this is how tax brackets work. Now, earned income, when we go and work for ourselves or for somebody, there's an additional tax applied, which we call FICA. FICA is the combination of Medicare and Social Security tax. So the Medicare tax rate is 2.9%, The Social Security is 12.4%. So there's a total of 15.3%. This is in addition to income tax. Now, the way this works is the employees, if you're working for somebody, you're a W-2 employee, you're only paying half that amount. You're paying 1.45% for Medicare and 6.2% of your total wages for Social Security. The remaining amount comes from your employer. This is one of the advantages of working for somebody else. If you're self-employed, guess what? You're the employer and you're the employee. You get to pay the full 15.3%. And that's in addition to the ordinary income tax. So folks who are self-employed, they feel like, gee, I feel like I pay a lot of taxes. And they're right. Between Social Security, Medicare, and regular income tax, they do pay a lot of taxes. Now, capital gains, investment income, is taxed differently. And the tax rate depends on whether it's long-term gain or short-term gain. So short-term means that you've held the asset for a year or less before selling it. Long-term means you held it for over a year before selling it. Congress is deeply invested in having people hold their investment assets for over a year. And that's why the long-term capital gain rates are so low. Short-term capital gains are taxed at those ordinary income rates that we just looked at. But when you hold that asset for a year or more, you get to take advantage of these special long-term capital gain rates. And check it out. Look how low they are. Look how low. This is amazing. Look how low these rates are compared with ordinary tax rate. 0% up to $89,250 for married filing joint. That's amazing. I mean, that's amazing. So when we talk about holding assets long-term, there's a huge tax break when you do that. So just to show you a quick example of this, of how capital gain rates are really so advantaged compared to employment income. So if you are a W-2 employee and you have, say, $60,000 of income, your total federal tax, including your FICA withholding, is just under $8,000. If you're self-employed, it goes up to just under $11,000. $60,000 long-term capital gain, no income tax, no FICA tax, total tax of 0. Wow, huge difference, huge difference. So investment taxation is very, very different from the taxes that we're accustomed to paying as employees or as self-employed. So let's talk a little bit about investment taxes. So different types of investment income taxed at different rates. There's that ordinary income rate, which I mentioned for short-term capital gain. There's that long-term capital gain rate. There's depreciation recapture, which we'll talk about. There's a collectible rate. And some investments produce income that is free from federal tax or free from state tax or free from all taxes. Boy, who wouldn't want that, right? Most interest is taxed at ordinary tax rates. There's no long-term capital gain when you earn interest. Interest is just ordinary tax rates. But there is such a thing as tax-exempt interest. So interest paid on municipal bonds is always federally tax exempt. That's by order of the Supreme Court, just by the way. So states don't get to pick and choose. You're not going to have a state that goes, yeah, I don't like that. We're not going to do that. They don't have that option. Interest on bonds issued by your state of residence or a locality, city, agency within that state is usually state tax exempt as well. But for most states, if you hold bonds from out of state, then the interest that you receive on those bonds is probably going to be subject to state tax in your state of residency. There are some exceptions, by the way. Oklahoma, Iowa, Wisconsin, and Illinois, they tax in-state bonds as well as out-of-state bonds. So we don't like that. So clearly tax-exempt interests don't have to pay as much interest because the tax savings attract investors anyway. They don't have to pay out as much interest to attract investors. The taxable interest rate that would be required to provide the same after-tax interest rate as the tax-exempt investment is what we call the tax equivalent yield. And there's a formula. We're not going to go deeply into the formula, but example here is if Mike here buys a 3% tax exempt bond, the yield on that bond, because it's tax exempt for federal governments and state and possibly for a state as well, but certainly for the federal, it's going to be the equivalent of a yield of 3.3% if Mike's in the 10% bracket. But if he's in the 22% bracket, the tax equivalent is 3.8%, and it goes up to 4.6% if Mike's in the 35% tax bracket. So the moral of the story here is this: the higher the taxpayer's tax bracket, the more attractive these tax exempt bonds are going to be. So when I have clients who are in a high tax bracket, what I know is that their financial advisor might advise them to get involved in tax exempt bonds because the return for those clients becomes pretty good. Now, taxes on capital gains. So we talked about interest. Now, capital gains occur in a couple of different ways. Typically, we think of capital gains as something that occurs when we sell an asset. We sell a stock, we sell a bond, we can sell mutual funds, and there's going to be a gain or a loss just depending on what you got for it when you sold it, on how much it cost you to buy it in the first place. Now, if you have mutual funds can also produce capital gain distributions even if you don't sell it. So you might have a mutual fund that you've been holding and you still get capital gains from it. And that's because some asset within that fund has been sold and has produced a capital gain or a capital loss. Now, the way capital gains and losses work is they offset each other. So I could have a capital gain and a capital loss that comes in and takes that gain down. Now, if I have more capital loss than I have gain, I can deduct it from the rest of my income, my ordinary income, up to $3,000 per year. If I have losses that are more than 3,000, that gets carried forward to the next year. Just heads up, just by the way, that $3,000 number has been around for a long, long time. If it had been adjusted for inflation in the beginning, it would now be about $14,000. So that's, yeah, kind of a terrifying thought, right? 14 grand, that would have been worth something. So that's how gains and losses net themselves out. They net each other out. And that's something that your tax advisor can help explain for your individual situation. So example, let's talk a little bit about tax planning. So here's Alice. She bought 50 shares of a stock, we're just going to call it ABC stock, at $40 each 4 years ago. She's held it for a long time now. She bought another 25 shares of the same stock for $75 each 6 months ago. Today, she decides she wants to sell 25 shares. They're now paying $100 each. She'd like to get some of that gain. Now notice the difference here. If she sells the shares that she bought 4 years ago, she'll have a gain of $60 a share, and it's long term. So she'd have a total gain of $1,500, and it would be long term. If she sells the shares that she bought 6 months ago, she'll have $625 of short-term gain. Which is better? Well, that's where tax planning comes in, because you get to decide which stocks you want to sell. You get to decide whether I want to sell those stocks that I bought years ago, the stock I bought 6 months ago, the stock I bought yesterday. You actually can make that decision. And it can be a good idea to sell profitable investments in a year when your income is otherwise low. So it can be a good time to catch those investments in and pay tax at a low rate. Now, dividends are a little bit different. There's ordinary dividends, and we call them that because they're taxed at ordinary tax rates, plain old ordinary 10%, 12%, 22%, etc. But there's a thing called qualified dividends. Qualified dividends are taxed at capital gain rates. So Mike here would very much prefer to have qualified dividends rather than ordinary dividends, because as we saw, those capital gain rates are amazingly low. So Mike calls his financial advisor and says, I only want qualified dividends. Well, qualified dividends, you don't really get to just pick and choose. It depends on the situation. Typically, qualified dividends are dividends from shares in domestic corporations. There are some foreign corporations that qualify, and the asset has to have been held for a specified minimum amount of time. They have to be unhedged, meaning that there were no puts, calls, or short sales during that holding period. It's the broker that makes the determination as to whether a dividend is qualified or not. Sometimes dividends are non-qualified simply because that dividend is including some form of taxable interest, short-term capital gain, something like that. There are also certain types of investments that never pay qualified dividends. Real estate investment trusts, we call those REITs, master limited partnerships, employee stock option funds, those only pay ordinary dividends. So there's this idea in tax world called harvesting tax losses. So the idea is this: if I have a stock, and you can see Mike here says, if I have a stock that's gone down in value, but I think it'll go back up, I think I should just sell it so that I have that loss to offset some capital gains, and then I'll just rebuy it. And that way I have the loss, but I'm still holding onto that investment for when it goes back up. Now, the problem with that idea is, I always say the IRS wasn't born yesterday, okay? So if you sell something at a loss and then you rebuy it within 30 days, you don't get the tax benefit of that loss. It's called a wash sale loss. And if you're getting ready to sell something and the wash sale loss rule might come into play, your broker can advise you as to that. So it's all about that 30-day timing. So for example, Georgia sold Peachy stock on December 30th at a loss, repurchased it on January 28th. Well, that's within that 30 days. So the loss is going to be disallowed, not going to be able to take advantage of that loss. However, let's say that that repurchase didn't occur until January 31st. The 30-day rule has been advised and the Peachy loss is now allowed. Now, some folks think I'm smarter than the IRS. I'll sell it out of this account and rebuy it in that account and nobody will know. Well, the wash sale rule actually applies across all your accounts, including IRA transactions, and it even extends to your spouse's accounts. So that wash sale loss rule is really hard to get around. So be aware that this tax loss harvesting is fine, works well, unless you then immediately go and repurchase that same asset. And in theory, it's up to each of us to keep track of what's happening across our different accounts. Now, there are different types of capital gains that have different rates. So for example, gains from collectibles have a maximum tax rate of 28%. And collectibles, according to the IRS, is things like artwork, coins, certain liquors, certain collectible wines, some types of jewelry, gold, silver. Those are all collectibles. Non-fungible tokens, for those of you that are more techie, are also now very probably going to be considered collectibles. The IRS has been issuing guidance on that subject. There's a thing called a qualified opportunity fund. Let me just spend a few minutes on that. So qualified opportunity zones, it's an economic development tool. The idea behind the passage of this law was that we wanted folks to invest in what they call distressed areas in the United States, areas that just weren't doing so well economically. This was passed by the 2017 Tax Cuts and Jobs Act. That act established the Qualified Opportunity Zone program. And investors in these programs are given a chance to defer and ultimately reduce tax on certain capital gains when they come from these qualified opportunity funds, when they're invested in qualified opportunity funds. So a qualified opportunity fund, taxpayers can defer the tax on a capital gain if they invest the money they have 6 months after they sell an asset. If they reinvest that money in a qualified opportunity fund, then they get to defer the tax, which can be very attractive to folks in high tax brackets. So the taxable gain that's invested in a qualified opportunity fund is not recognized until the end of 2026. That's a tax return that'll be filed in 2027, or when the interest in that fund is sold or exchanged, whichever happens first. Now, also, if you hold your investment in the fund for at least 5 years, your basis increases by 10% of the deferred gain, meaning that there will be a decrease in tax as a result. And if the investment's held for at least 7 years, basis then goes up by another 5% of the deferred gain. So this was a really big opportunity for folks. And the idea, as I say, was to help some of these socioeconomically disadvantaged areas of the United States. There's also potential to permanently exclude gain from a qualifying investment. This is something that is good for some folks, not that great for others. So this is something you'd want to talk to your tax advisor about to see if the Qualified Opportunity Fund is a good idea for you. It's very individual. Oil and gas investments have special tax opportunities. A lot of people invest in oil and gas because of the potential tax benefits. Now, you know, I'm no way saying that taxes should completely govern how you invest, but certainly losing money because of taxes can really make what was otherwise a great financial opportunity a not so great financial opportunity. So taxes, when it comes to investments, can be a very big deal. So for oil and gas, intangible drilling costs, 100% deductible during the first year. Tangible drilling costs, 100% deductible. There's a depletion allowance for oil and gas. It's 15% of that gross revenue is a deduction. You don't have to pay tax on it. Active income deductions can also be deducted against business income. And when you invest in oil and gas, you get a nice report every single year, January, February timeframe, which tells your tax advisor what those active income deductions are, what the drilling costs are. Your tax advisor knows how to handle the depletion allowance. So there are a lot of folks that make a lot of money and get a lot of tax benefits through oil and gas. Now, I mentioned earlier about real estate investment trusts, which we call REITs. And what a REIT is, it's a company that owns, operates, or finances income generating real estate. So the concept behind REITs is that most of us are, you know, we're just little fish in the pond, and we don't have an opportunity to get involved in things like building shopping centers, building hospitals. We're just, you know, how do I get involved in building a hospital? Well, I can actually do that through a REIT. So a mutual fund, it operates in the same way. A REIT is like a mutual fund. It pools the capital of lots of different investors, small investors, and between all these small investors, there's enough money generated to do something like build a hospital or build an apartment complex. So it gives each of us individual investors an opportunity to get involved in these big real estate projects without having to buy, manage, finance them on our own. Now, the dividends that we receive when we invest in REITs, it's kind of an interesting situation. They're taxed as ordinary dividends. REITs do not give qualified dividends, but they are subject to a special deduction called the qualified business income deduction. And you actually get to subtract from interest 20% of the dividends you got. 20% comes right off your taxable income. It's a smoking hot deal and has made REITs incredibly popular. I'm going to take a quick little side journey here into cryptocurrency. We're not going to go too deeply into this, but I just want to explain a little bit about cryptocurrency, what it is, why we have it. Let's talk about why. So just to start off with, I know a lot of folks that have a lot of Bitcoin or Ethereum or whatever. It was never intended to be an investment vehicle, just to be clear. Cryptocurrency was actually intended to be the foundation of a new type of financial system. So financial systems kind of come and go, okay? And cryptocurrency was meant to be a new financial system. What happens typically over history is that when a financial system's flaws begin to outweigh the benefits, then a new system evolves. So what was seen in the current financial system was that it takes very expensive third parties to move money between people. So if somebody's going to pay me for something, unless they're sitting right in front of me with cash in their hand, a third party's involved every time. A credit card, a debit card, PayPal, Venmo, whatever, there's a third party. And those third parties cost billions of dollars to do nothing more than to move value from one person to another. Another problem with the current system is 14 million people in the United States alone do not have access to banks. Fraud and forgery continue to be problems with our current system, and the government, who's in charge of our fiat currency, gets involved, and it's not always helpful. So it's typically new technology that helps a new financial system come into play. So coins, metal coins, could not come into being until we had the technology to create them in massive amounts. We couldn't utilize paper currency until federal laws made them fiat currency, and we couldn't create cryptocurrency until the programming involved became sufficiently sophisticated. And it's been decades in the making for cryptographic programming to finally reach the point where it could actually function like currency. So the idea here, Bitcoin was the first major currency. The idea was that Bitcoin would be a medium of exchange and a store of value. That was the concept. A lot of folks jumped on board early on, some because they really supported the idea of not paying billions of dollars to, to credit cards and debit cards and banks. Others because they thought they could escape paying taxes, which many of them did. So the perceived benefits were that there was no third-party requirement. We could pay each other directly. Anyone with a computer and Wi-Fi could transact. You didn't need to have a bank account. Fraud and forgery within the blockchain itself was impossible, and the government could not interfere. That was the concept. Now, how do we tax it? So the IRS actually treats cryptocurrency as property, treats it as property. So when I sell my Bitcoin, I have a gain or a loss, could be a capital gain or a loss, could be long-term if I've held it for more than a year. If I exchange it for a different type of cryptocurrency, there's a capital gain or a capital loss. If I work for somebody and they pay me in cryptocurrency, it's ordinary income. So cryptocurrency is definitely taxed by the United States government. Now, the problem has been that folks have not always been paying tax on their cryptocurrency. It's been a problem. So I have had people tell me outright, I'm involved in crypto because I don't have to pay tax on it. Well, that's changing. That's changing. Starting in 2026, exchanges are going to be required to report gains and losses on crypto, just like your broker reports gains and losses on stocks and other investments. So the only reason to invest in crypto is if you think there's a sound financial reason to do so, not because you think you could evade tax, because those days are coming to an end. So just some ideas, we call them tax savvy concepts. So one thing to be aware of is your state of residency really has a lot to do with how much tax you pay. Full disclosure, most of us are stuck in the state we live in because our family's there or we grew up there, whatever. Most of us are stuck. If you're not stuck and you think maybe it's time for me to move, just be aware that some states are friendlier, tax friendlier than others. And when states are being evaluated for tax friendliness, they consider income tax rates, property tax rates, and sales tax rates. So this is just a slide to show you the top 10 tax-friendly states and the least tax-friendly states. So I'm happy to say I live in Arizona. We are a tax-friendly state. Our income tax here is a flat 2.5%. So tax planning also involves this concept, which we call defer, 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 die. We call it the 4 Ds. So the concept here is to defer tax until you die, at which point your heirs get a stepped up basis in assets and they avoid tax entirely. Now, people don't really like it when I say defer, 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 die. So people seem to take that personally, but when we talk estate planning, we got to be realistic here. So for example, Mike has a stock portfolio worth about $1 million. He bought this stock a long time ago. He paid about $200,000 on it. And if he sold all that stuff, he'd have to pay tax on about 800 grand. It'd be long-term, but that's still a lot of money and a lot of tax. But on the other hand, if he doesn't sell it, but he just lets his heirs inherit it, then they get stepped up basis, meaning that for tax purposes, that stock is treated as if those heirs had paid $1 million for it. So if they sell it right after Mike dies, they actually would pay no tax at all. Okay, so that's what we mean by defer, 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 die. Now it also works for real estate. So Harriet here has a piece of rental property she's owned for many, many years. She bought it back in the day for 100 grand. She's taken $80,000 of depreciation on it. She'd like to leave some money to her daughter. So her plan, she goes into her tax advisor and she goes into Craig and she says, I'm gonna, he's laughing, I'm gonna sell it and give my daughter the money. And Craig, since he wasn't born last week either, says, no, 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 let's let the daughter inherit it. Why? Because if she sells it for she could sell it for 300 grand, but she's gonna have to pay tax on the 80% of depreciation recapture. That's gonna be ordinary rates up to 25%. Plus she's gonna pay capital gain on that $200,000. There's a lot of tax. And her tax advisor can sit down in about 5 minutes, tell her, hold on, sweetheart, this is how much tax you're gonna pay. Instead of that, let's let your daughter inherit it. The daughter gets a stepped up basis. Then the daughter can sell it and she pays no tax on it at all. So who wouldn't want that, right? Okay, so charitable giving. Let's talk about that. So Abby would like to make a sizable donation to the World Literacy Foundation. It could be any charity. I just picked this at random. She tells her tax preparer that she's going to sell her Tesla stock and give the proceeds to charity. Her tax preparer calculates that Abby will have a nice $50,000 charitable contribution deduction. That's nice, but she's going to pay $20,000 on the sale of the stock. Maybe not such a great idea. So instead, her tax preparer says, tell you what, donate the stock to the organization. Just donate it directly. Don't sell it. Now, if Abby has owned the stock for at least a year and it's gone up in value, she can deduct as an itemized deduction the fair market value of the stock with no tax consequences at all. No tax consequences at all. Now, she only gets a benefit if she itemizes deductions, but she's selling Tesla stock. She's probably going to itemize on the strength of that alone. But what you want to do is you want to talk to your tax preparer before you do things like this and understand what the tax ramifications are. Really frustrating for the tax preparer when you come in after the fact and they go, oh my God, I wish you hadn't done that. Okay, so here's another thought. Kathy would like to make a sizable donation to the Red Cross. She tells her tax preparer she's going to sell that loser stock she bought a few years ago and give the proceeds to charity. Now, in this case, the tax preparer agrees, sell the stock and take the loss, and then give the proceeds to charity. So it depends on the situation. There is no one size fits all scenario. That's why all of us tax folks say, please come in and talk to your tax preparer before you do anything. There's also a thing called donor advised funds. And what a donor advised fund is, it's a private fund administered by a third party, created for the purpose of managing charitable donations on behalf of an organization, a family, or an individual. So donor advised funds is another way to make contributions. And these donor advised funds accept stocks, mutual funds, bonds, S Corp stock, C Corp stock, and these donations are typically also deductible as an itemized deduction. Now, it's something to think about for us older folks, 70 and a half or older. We can make a thing called a qualified charitable distribution directly from our traditional IRA. The way it works is that we have our trustee give the money directly to a charity, and we don't pay tax on it at all. If you have required minimum distributions, then this charitable distribution can count as some or all of your RMD. This is the way to go. If you are required to take distributions, you've hit that RMD age, and you want to make a donation, this is the way to go. Talk to your financial advisor, talk to your tax preparer. All right, let's move into retirement. Take it seriously. Surveys show that only 14% of Americans have 100,000 or more in their retirement accounts. 78% have 50,000 or less saved for retirement. These are terrifying numbers. Half of American households have no retirement savings at all. More than 17 million, 1 in 3 adults 65 and over, live at incomes below 200% of the federal poverty level. They are barely making it. This is something to take very seriously. And I'm going to say for younger folks, it's the money you put in when you're younger that has the biggest impact on how much money you're going to have saved for retirement. You will hear people use the terms qualified and non-qualified plans. They're talking about retirement accounts. And a qualified plan, that term refers to employer-sponsored retirement plans that satisfy the requirements in the Internal Revenue Code to get tax-deferred treatment. Pretty much any retirement plan that's offered by an employer is going to be a qualified plan. These could be 401k plans, 403b plans, defined benefit plans. These qualified plans allow taxpayers to deduct contributions and not pay tax on the investment income until they take the money out. Different plans have different rules, so you have to pay attention to the details. Talk to your advisors. For folks who are self-employed, there are a lot of options. There's traditional IRAs, Roth, SEP, Simples. You want to talk to the tax preparer about your options. So I'm speaking as someone who's headed for 70, I'll just say it's hard enough to be old. It's really hard to be old and sick, but old, sick, and poor, that's about as bad as things get. You don't want to be that guy. So take this seriously, plan for retirement. Now, IRAs, there's a thing called a Roth IRA, which is very, very different from a traditional IRA. So the way a Roth IRA works, and it's named after the congressperson who introduced it, the taxpayer contributes post-tax dollars, meaning they don't get a deduction for the contribution. Traditional IRAs, you typically get a deduction. You get to subtract what you put in from income, and so everybody likes that. But it's not such a great thing when later you go to take the money out and you have to pay tax on it. So the Roth IRA is the exception to that. With the Roth IRA, you don't have an immediate tax benefit, but later the tax benefits are big. The money grows tax-free, and the plan owner can make tax and penalty-free withdrawals after 59 and a half. There are some income limitations. There are some longevity limitations for the account. You want to talk to your advisors, your financial advisor, and your tax advisor to see if this is a good idea for you. So Roth IRAs are probably best suited for taxpayers who expect to be in a higher tax bracket when withdrawals start. There are no immediate tax benefits. It's a later tax benefit. Traditional IRAs are best for taxpayers who expect to be in a lower tax bracket when they start taking withdrawals. So there is no one-size-fits-all solution to this. Everyone's different. Everyone's financial situation is different. So you want to talk to your advisors to see what's going to work for you. Now, there's a thing called a Roth conversion strategy. Now, if I'm stepping on somebody's toes here, you should stop me because I know that you're about to talk about Roth conversion strategy. Should I continue or no?
Continue. You're good, Amy.
Okay, so there's a thing called a Roth conversion strategy. So what this means is a Roth conversion strategy means I've got some money sitting in my traditional IRA that I am going to pay tax on when I take that money out. Maybe I have a low income year, and that might be a time for me to take that IRA money and roll it over into a Roth IRA. I will pay tax on it in my low income year, but down the line, I can take the money out tax-free, which at some point starts to look pretty good. So that's one reason to do a Roth IRA conversion. Allows the taxpayer to convert all or part of their traditional IRA to a Roth. There's no penalty levied. The amount that's converted is taxable income, but it does allow taxpayers to take advantage of the Roth IRA's main important features: tax-free withdrawals of contributions and earnings in retirement, as long as that account's been held for at least 5 years and the taxpayer is at least age 59 and a half. Like I say, everyone's different. Everybody's tax situation is as unique as their fingerprints. So before you rush into anything, you talk to your financial advisor, you talk to your tax preparer about these investment strategies so that you understand what you're getting into. Before you sign on the dotted line, make sure you understand the situation and how these different ideas apply to you. So that said, I'm turning it over. Who's next?
Well, first,
Awesome.
Amy, I just want to say thank you. That was incredible. But I'll let Judd talk. I don't know how you're gonna follow that, but thank you, Amy.
My pleasure.
You are right.
My
I've
pleasure.
so enjoyed getting to meet Amy, and Craig said she was just going to be an amazing speaker, and I second that. Thank you so much, Amy. We appreciate you doing this and during the holidays. So I am going to mention a couple of things before I introduce Tanner Bailey, and that is Craig and I are huge fans of QOFs, or OZs, as I call them, opportunity zones. Also, oil and gas, intangible drilling costs, excellent tax deductions. And also, she talked about donor advised funds. We can take that a step further. And by the way, Craig and I have been doing a series of webinars since August. And on his website, Mooresville Tax Service, you can find a tab with webinars. And so you can listen to each and every one. We had a few of those that had information about QOFs, oil and gas, donor advised funds, and then talking about Roth conversions. Tonight, Tanner Bailey, Regional Vice President with Skyway Capital, a Tampa-based investment banking broker dealer, has a very unique way to take that Roth conversion to the next level and not only do that at a discounted amount, but also diversify your assets into real estate. As many of you know, real estate has lower correlations to the stock market and or the bond market or international markets. So I'm going to go ahead and turn this over to Tanner Bailey with Skyway Capital Markets so we can talk about
real quick, Joe, before you turn it over, Amy has a meeting she's got to go to, so I want to let her go. Bye, Miss Amy. Thank you.
Merry Christmas, Amy. Yeah, so Tanner, I'm gonna go ahead and stop sharing and let you come on, sir.
Perfect. All right, so I'm going to share my screen real quick. Judd, are we good? We seeing it? Excellent. All right,
Yes,
so
sir.
thank you very, very much. That was, I'll echo Craig and Judd's sentiment. That was extraordinarily informative and timely as we enter the upcoming tax season. As Judd said, my name is Tanner Bailey. I'm a regional vice president for Skyway Capital Markets. As he mentioned, we are a Tampa Bay based investment bank. And then we also help raise capital for private alternative offerings. And I do want to reference one of those today, but because of the timeliness of Amy's presentation and kind of where she left off, I think it makes a lot of sense to discuss this strategy that Amy kind of talked about and that Judd, obviously wanted us to spend some time on here. So Roth conversion, you got the 101 from the Roth conversion 101 from Amy earlier, but to echo what she mentioned, this is a great tool for investors that are looking to limit the tax consequences on investments that they make with traditional qualified or IRA money. If we want to take a step back and think about a $100,000 account that's funded with traditional IRA money, that is money that has not been taxed, you are technically allowed to convert your traditional IRA account into a Roth account at any time. And if we remember from Amy's slide, the only consequence you have is you have to pay the taxes on the value of that traditional IRA. If we invest, or if we have $100,000 traditional IRA and we invest that, and we convert that account into a Roth, and let's just say we're in the 30% tax bracket, that means we have a $30,000 tax bill at the end of the year. Why our offering and why some of the investments that you can make with Skyway make a little bit of sense is we actually have an opportunity where there's a 12-month window where your investment actually is valued at a discount. And we can talk about how we get there, but let's just say, for a 12-month window, which as Craig referenced, that actually spans 2 different tax years, believe it or not. We started in the springtime of one year and it ends in the springtime of the next year. So while it does only last 12 months, it covers 2 different tax years. So you can convert, multiple back-to-back tax years should you choose to do so. But there's a period of time where that valuation of your investment is actually discounted between 30 to 40%. Let's just say conservatively, your $100,000 investment in our offering is temporarily discounted to about $70,000. That $70,000 valuation lasts 12 months. And it's during this 12-month window where it makes all the sense to convert that traditional account, traditional IRA, into a Roth IRA. Why? Because remember, you're paying taxes on the valuation of, or pardon me, on the value that you are converting. If your account is temporarily valued at 70,000, 30% on 70,000 is $21,000. Your tax bill is $9,000 less than if you converted your account when and at its original $100,000 investment value. The unique thing about how our offering works is after that 12-month window ends, your investment actually goes right back up. It is revalued, so to say, right after that 12-month window ends. So there is not a period in time where, even though the value of your account is temporarily discounted, you have not lost a single dollar. It is just a paper discount. And then remember, as Amy mentioned, once you've converted that account into a Roth, that growth is tax-free. So let's just say you have a Roth account with you have $100,000 investment. You converted your account at $70,000. You pay the $21,000 in taxes that year, and then it's revalued back up to $100,000. If you have a 4-year time period with a 15% average annual return, that's a $160,000 account that you can start pulling, money after you turn 59 and a half. That money you can take out tax-free. So this is a very, very, very strategic and opportunistic opportunity, really, that fortunately our offering, a couple of the sponsors that we work with provide. So I'm going to pivot real quick
quick, Tanner. If our attendees would like to take that strategy one step further, if you are interested, please call us, because we could show you how you could wipe out that income tax on the conversion. So it's not applicable for everyone. These strategies are for accredited investors only, and we can tell you what that is. But you should go check out some of our webinars. We talked about some of these things. Tanner was included on the one that we did 4 times ago, I believe. But Tanner, sorry about that. Take it away on Mill Green 9. By the way, this is their 9th fund, y'all. This is not Johnny come lately. They have been doing this for a bit. They've got some experience.
I need to give Craig and Judd a Skyway business card, because they do such a good job selling my deal. As Judd referenced, the investment offering that provides this Roth conversion opportunity, it's called the Mill Green Opportunity Fund 9. And as Judd referenced, this is the 9th fund. We've gone full cycle, meaning we've completely closed out and sent back all of our investors their money on 5 of our previous 8 funds. The remaining funds 6, 7, and 8, those are currently in their cycle process of building and leasing and selling. And I'll talk about what we do and why it matters. So Mill Green, their process and what they do is very, very simple. Their goal is to contract, build, lease up, and sell Class A garden style multifamily complexes. And what is a Class A garden style multifamily complex? It's basically what you're going to see in this picture. These are communities, gated communities, that are rental residential units. They're going to have, all of the highly amenitized features like stainless steel appliances, hardwood floors, beautiful cabinetry, all of the external amenities, the pools, the gyms, the bocce ball court that you see here. Here's a couple more pictures. These are, for all intents and purposes, the nicest assets that you can buy within the asset class that are not your stereotypical apartment complexes, mid-rise and high-rise, right? These are going to be, 250 to 300 unit assets. They're going to be, roughly 3 to 4 stories high and multiple buildings throughout a single community. Now, why is this type of asset such an opportunistic investment? It's really based on where we're investing. I'm sure a lot of you are aware of some of the trends, the economic trends that we've seen specifically in the part of the country that's highlighted right here. But we do build these in what we like to call secondary or tertiary markets within the Southeast. And what makes it secondary or tertiary market? Essentially, it's any major market that, or it's any market that is not a major downtown market, like a downtown Atlanta or a downtown Miami. Mind you, we do build in Atlanta, but we build on the outskirts of Atlanta, the northern Atlanta metro area, Alpharetta, Marietta, that part of that market. But why do we like these markets? Why do we like Tampa? Why do we like Charlotte and Raleigh? Why do we like Nashville? If any of you live in these markets, I'm sure you can pretty much figure out why. They're growing markets. You know, obviously COVID accelerated a lot of the population growth that we've seen in these local markets. All of the population growth is driving job demand, and we're seeing that. We're seeing job growth. And most importantly, we're seeing wage growth. And all of those things, all of those economic indicators aggregate into one really important metric that we focus on, and that's rent growth. And that's kind of how we sell these assets, right? We sell these assets to major institutions that are interested in the potential rent growth that our asset has, or that our asset provides. So if you want to think about kind of nationally, you know, throughout the nation, the average rent growth in the year 2022 is right around 2.9, or let's just say roughly 3%. If you take the markets that we build in, these southeastern markets, they're experiencing substantially greater rent growth, closer to 10%, right around 9.7. So that's a huge selling point when we actually lease up these assets and go to market to sell them. Institutions are chomping at the bit to take a look at our assets because A, they're beautiful, B, they're brand new, and C, they're located in desirable markets. Now, real quickly, I'm not going to go much longer, but I do want to pivot back to how this all plays in within the Roth conversion. So because these are developments, there's a period in time where, you know, not all of the investments that our fund makes will be in the same process of the development cycle. So Fund 9, we're raising about $150 million. Again, you have to be an accredited investor. I'd urge you to have a conversation with Judd should you be interested at the end of this call. But $150 million, we're going to make between 10 and 12 investments in multifamily developments. Now, those investments are not all made at the same time. Those investments are going to be made periodically over a 6 to 9 month timetable. After we close the capital raising period for our offering, we do send out a third party. It's what you see here. We send out a third party appraisal group to go to every single site that we've invested in. And some of those sites, they may have 2 of the 5 buildings built. They may have some foundation laid. Some of them might still be dirt lots, because remember, we're buying plots of land, cutting everything down and building up from that point. But what we get from that third-party appraisal group is an aggregate value, or an updated aggregate value, that should we have to fire sale the entire portfolio, that's what the valuation would look like at that point. Remember, we don't have any intention of doing so, but we need a discounted valuation so that we can provide our investors that Roth conversion opportunity. So that's how we generate that 70,000 that you see right here, or that 30 to 40% discount. I'll finish with just echoing the sentiment. This is a really, really interesting and unique opportunity that is not easily accessible in an investment, in a real estate investment like this. So should you be interested in limiting the amount of money that we have to pay the IRS, and you want to diversify with some real estate, I'd highly, highly, highly encourage you to reach out to Judd and reach out to Craig and learn a little bit more about this, because this is a very unique and opportunistic investment time.
Awesome. Tanner, thank you so much for coming on and speaking for us again. Folks, this is amazing. And, I think one of the things that Craig has really enjoyed in our informally shared clients, when we do the tax strategy for them, I actually have done all of these myself. I sold my office building. Some of you on the webinar tonight know that. I depreciated it over time. As Amy talked about, I had to take that as income. I also had capital Gaines. I owned it for 16 years. Had live in a great area here in Charlotte. And so I had to do a qualified opportunity zone. I had to do oil and gas. And I am getting ready to do some business with Milgreen. So at the beginning of the year, I'm going to move about 100,000 of my own money over to Milgreen Fund 9, get in on this and do some conversion, because I'm definitely going to want to have some tax-free retirement assets in the future. Craig, any bullet points you'd like to add in before we let people go for the holidays?
Well, no, I think Tanner did a wonderful job. Amy did a wonderful job. They did better than you and I would have done.
Agreed.
And also, I don't know if you can get in that Milgreen fund, but being your accountant, Judge, you know, this may be a year that you need to get in before December 31st, if it may be too late.
No, we still got time, right, Tanner?
Okay.
When do you expect your offering to close, Tanner, for Fund 9?
It's a great question, Judd. We expect probably sometime mid-year next year, probably right around May or June.
Okay, fantastic, good deal. And that's when the third-party evaluation is going to be done. We'll come back, we'll see that really nice. You know, most people don't want to see their statement go down 30 or 40%, but in this case, you do. I'm going to be jumping up and down because I will be converting over that 2-year period. And again, folks, real estate is not really correlated as much to the stock market or the bond market or overseas market. This is a great way to have a diversifier, and the IRRs have been nothing short of phenomenal. Their execution, folks, has been great. And these states that they're doing these developments in, it's where we want to live. It's where we do live. So fantastic. Thank you all for your time tonight, for your business and trust. And above all, y'all have a fantastic holiday season ahead.
Happy holidays.
Take care.
Wow.